MKS Instruments is a provider of instruments and systems in general to measure, monitor and analyze critical parameters of manufacturing processes. Most of their revenue comes from supplying semiconductor manufacturers such as Applied Materials and Lam Research, and they recently announced their intention to acquire the German special chemicals company Atotech, which would possibly produce several cost synergies and more complete product solutions. To value the stock both with and without the upcoming acquisitions, I performed a discounted cash flow analysis according to US. The respective obtained fair values are $126 and $115, so stick around to see how I ended up there. The market cap is around $5.5 billion, PE ratio is 9.5, the EV to EBITDA ratio is 6.65, and they recently paid a dividend of 0.89%. I came across this company through a screening on my website StocksOnView, which enables you to save a lot of time with finding stocks tailored to your investment strategy and also to monitor them in your portfolio. So, in the course of this video, I'll use the stock screener, take a look at the company's fundamentals, followed by the latest 10K files. After that, I'll try to assess risks and chances from it and metrics for a discounted cash flow analysis to calculate its distribution of fair values for the stock. Let's jump over to the screener so that you can follow me along on how to find possibly interesting companies. I usually want the market cap to be at least $1 billion to filter out the very small caps and the EV to EBIT ratio to be lower than 20. This makes sure that I only get profitable companies as a result that are not excessively highly valued. Regarding growth, I would like to see the company to increase revenue and income at least at the historic market return rate. Only like this, they should be able to match or outperform it sustainably and like so be a better investment than an index fund. As far as debt is concerned, I'm a friend of companies that can pay off theirs in the foreseeable future from reserves and the current cash flows. For margins and fundamental ratios, I'd like to use our ranker tool. This allows you to search for companies that perform well in a metric relative to the sector. Ideally, I want both the return on equity and the operating margin higher than 50% of a company's competitors' metrics. MKSI is trading at a low multiple despite a high growth in the last 5 years, great rankings regarding its sector and debt multiples, which is why today we take a closer look at the company's fundamentals, its business model, competitors and potential risks. So if you click the company's name in the StocksOnView dashboard, you are redirected to an analysis tab divided in a few sections meant to guide you through the fundamental analysis increasingly in detail. Almost always when a key figure is displayed, you can click on the icons on the right to get a short explanation or a frequency distribution to better understand and interpret it. The blue bar chart below represents its ranking on the company's respective sector. The price-earnings ratio, for example, is lower than that of 2/3 of the companies in the same sector. Also, the price-to-sales ratio seems to be quite low for a semiconductors-related company. The stock price dropped around 50% from their recent highs, which you cannot say about their fundamentals. In the last 5 years, MKS managed to increase their revenue by 93.5% and income by 185%. Besides that, they saved up a cash reserve of around $1 billion ready to pay off debt or for an acquisition. Also, the overall figures and ratios of the company look quite good. Analysts rate the company at 4.5 out of 5 in the categories fundamental ratios, growth, assets and debt, and margins. The company ranks consistently over the sector median, and the paid dividend of 0.89% is covered well by the company's cash flows. Finally, a list of competitors categorized after the GIC classification can be found on the last tab. Since the overall fundamentals and metrics look good, I'll now take a look at the 10K filings and sum up the results for you. So, simply said, MKS Instruments is a provider of equipment to precisely measure, analyze and control temperature, pressure and the composition of substances and mixtures. In addition to that, they provide anything you could need to fabricate semiconductor devices. The company also provides services relating to the maintenance and repair of its products, installation services and training. Its primary served markets include semiconductor and industrial technologies, life and health sciences, and research and defense. You can see a condensed list of their products here. 62% of the company's revenue stem from the semiconductors market, 38% are from industrial technologies, life and health sciences, and research and defense markets. With 43%, the USA is its main sales region. Besides the distribution by market, They also provide one by type of service and one by type of product. And you can see that while they earn most of their bucks in the semiconductors industry, they make more money selling analysis equipment and valves than with selling optical products or lasers. In the last 3 years, MKSI's 10 largest customers were responsible for 90% of the compounded growth achieved, with Lam Research and Applied Materials accounting for approximately 27% of the company's revenues. But more on that later. Let's see who are the executives first. John T.C. Lee is the company's CEO since 2020 and with the company since 2007. He holds a PhD from MIT in chemical engineering and worked at Applied Materials Incorporated and Lucent Technologies before. Seth H. Bagshaw is with the company since 2006 and is CFO since 2017. He holds an MBA from Cornell and worked at VET Corporation and Varian Semiconductor Equipment Associates. And lastly, James H. Reiner joined the company as COO in 2019. He holds a Bachelor of Science in Electrical Engineering and an MBA from the University of Colorado. He served in leadership roles at Plexus Corp, ILX Lightwave Corporation, Tetra Pak and 3M Company. I like them at a first glance, I have to say, because each of them has an engineering or somewhat scientific degree and on top of that experience in managing big players from the industry in a broader sense. Like so, they probably understand the products, the manufacturing, competitors' products, and they all bring a network of potential customers to the company. Since it's hard to identify the one true competitor for companies with such a broad product range, they provided a list of competitors in their 10K for their different product categories, which you can see here. Also, for the risks and chances that come with investing in MKSI, you could find a lot in the filings. To grow, the company invests a lot of money in acquisitions. Especially in the last few years, they were pretty successful with this strategy. Simultaneously, they managed to keep their return on equity high with regards to their peers and do not dilute their shares outstanding too much, which is exactly what you want to see when looking at the numbers. On top of that, they pay a small dividend. One metric you should always be checking when analyzing a company acquiring a lot is the goodwill. Goodwill is an intangible asset emerging when a company buys another company and represents the difference between the price paid for the company and the fair value of the assets and liabilities of the bought company. You might say goodwill is what the acquirer pays too much due to intangible assets such as brand names, loyalty of employees, or other intellectual property held by the acquired company. The problem is that oftentimes such assets are hard to quantify and their value might depend on current market conditions. Now, what's the problem with it? Companies have to re-evaluate the value of their assets regularly. If they amassed a lot of goodwill, it might happen that if the market conditions change, new competitors arise, etc., the goodwill has to be valued less, which in a consequence lowers the company's assets. This is then called a goodwill impairment charge. Now to bring this back to MKSI again. They lately reported total assets of $4.65 billion and a goodwill of $1.23 billion, which is in a relation relatively much. On the 1st of July 2021, they entered into an implementation agreement to acquire Atotech for an aggregate amount of $5.1 billion. Keeping MKSI's current market cap of around $5.5 billion in mind, this is kind of a big acquisition. The $5.1 billion would consist of $16.20 cash per Atotech share and an additional 0.0552 share of their own common stock for each outstanding common share of Atotech. Since the valuation of the market dropped since then, this is way above market value. At least in their latest publications, they stated that the final value will be determined at the time of closing the acquisition, which is expected in the third quarter of 2022, since they still have a pending approval of a Chinese court. Now, such a big acquisition is bound to some chances and risks. Atotech is a leader in specialty electroplating and surface finishing solutions worldwide located in Germany. They are currently valued at around $5 billion, a price to sales ratio of 2.5, and reported $1.5 billion of revenue in 2021. You can, by the way, see any ratio, the sector rankings, balance sheet, income and cash flow statement on our StocksOnView dashboard. Given a successful integration into MKSI's business, their management expects to produce $50 million of cost synergies annually. Besides that, it would also allow the newly formed company to further diversify income streams and dependencies on individual customers, as you can see in these pie charts here. In contrast, it could happen that the business of Atotech is not successfully integrated. In their latest filings, for example, the management states that they may never realize the business opportunities and growth prospects as they are intended today since they do not have previous experience in the specialty chemistry industry, which Atotech serves. The specialty chemistry industry is also subject to highly complex environmental regulations across multiple jurisdictions around the globe and may expose them to significant additional liabilities for past or future activities. About that point, I'm unsure about its interpretation because Atotech is already doing business in this segment. In a consequence, their management already should know how to handle the regulations. A risk they definitely do face is a tightening of the existing law and thus higher production cost. But let's set the acquisitions aside for a moment. The semiconductor market has historically experienced cyclical variations in product supply and demand. It is subject to rapid demand shifts, which are difficult to predict. If MKS was bad at predicting them, they wouldn't be where they are today, but still. MKSI's semiconductor market revenue, for example, sequentially increased 32% in 2021, sequentially increased 49% in 2020, and sequentially decreased 19% in 2019. Approximately 62% of the net revenues of 2021 were from sales to semiconductor capital equipment manufacturers and semiconductor device manufacturers. Another bullet point that could be named as a risk is that MKSI does not have a long backlog, but rather depends on the timely support of products and services that meet the rapidly changing technical and volume requirements of their customers. This depends in part on the timely delivery of parts, components, and subassemblies from suppliers, including contract manufacturers. The current supply chain disruptions are a permanent threat to this strategy. About the customer and market allocation of their revenues, we should have talked enough until here. Speaking of geographical allocation, it is notable to say that 20% of the company's revenue currently is coming from China and Taiwan. This is a risk, I agree on that, but honestly speaking, this conflict is probably a risk for most of your investments in the bigger picture. Given the bullet points I brought together, I conclude the qualitative risk for MKSI, including the possible acquisitions of Atotech, to be high. To get an intuition for the quantitative risk, I usually look at 5 ratios that I believe are good illustrations of the robustness of the company's business model. And in an assumption that Atotech will soon be part of the company, I added both companies' metrics to the table. For MKSI alone, I'd conclude the quantitative risk to be low compared to the sector and also in general. In case the planned acquisition works out, the metrics still look okay. Given the cost synergies work out, the metrics could even further improve. But since this all comes with a lot of uncertainty, I would say that the quantitative risk taken when buying shares of MKSI is as well somewhat around medium-high. So combining both quantitative and qualitative risk, I'd conclude that shareholders of MKSI would face a high risk at the moment. To estimate a fair value of MKSI, I perform a Monte Carlo simulation of discounted cash flow calculations. This method is adopted from Aswath Damodaran, a professor of finance at NYU, explained in his video up here, or in his book, The Dark Side of Valuation. I simulate 10 years of cash flows discounted back to today and apply a terminal multiple to the last simulated cash flows. With regards to the acquisition of Atotech, it probably makes most sense to do both one with and one without. So let's think about some input variables. Over the last 5 years, MKSI grew its revenues at a compounded annual growth rate of 14%, with a standard deviation of around 15%. In the same time frame, ATC recorded a revenue growth rate of 6%. The semiconductor market is estimated to grow at 5.9% annually in the next 4 years, and the PCB market, which after a successful integration of Atotech will be more important to the company, is estimated to grow somewhat between 3.3% and 5% in the next 5 years. The analysts' consensus for the company's growth rate is 6%. So MKSI already has a high market share in most of its segments. So for the simulation, I assume an annual revenue growth rate that is normally distributed with a mean of 5% and a standard deviation of 15%, in case the acquisition is taking place. MKSI's operating margin averaged at 19% in the last 5 years, ranging from 12 to 26%. Atotech's operating margin was 16.47%, on average ranging from 11.3 to 19.6%. So for the acquisition, I'd set the value for the simulation at 18%, ranging from 11 to 25%. The historical average of MKSI's enterprise value to EBIT ratio is 16.6, and it's currently trading at 8.8. The current price to EBIT ratio of Atotech is 15.8, and in the technology sector, the current median enterprise value to EBIT ratio is 22. I will be using the current enterprise value to EBIT ratio of 8.8 as the terminal multiple applied to the discounted cash flows of the last period. For the discount rate, I'll select 10% because this is the return I'd at least want to see when investing in stocks. Many investors use the weighted average cost of capital here, but the WACC, the weighted average cost of capital, uses the capital asset pricing model, which in turn uses the beta as a measure for the risk. Since I don't think that this is very accurate, I do not use it. For the case in which the acquisition takes place, the Monte Carlo simulation yields the fair value of MKSI shares to be $115. For the current share price of $98, this offers a margin of safety of around 17%. In case the acquisition would not happen, the fair value would be around $126, offering a margin of safety of around 29%. Given the current market conditions, I would handle such a result with care, since I assumed growth at a time that many things can go wrong for a company depending on global trade or a short backlog, for example. Even though I personally like the company and what they do, which is not to be taken as investment advice by any means please, I'd currently be careful with investing. Lastly, I'd like to lose some words on my own behalf. All the quantitative analysis is done via my website StocksOnView.com, which a friend and I created to make the tools we use accessible for everyone. Many tools are free of charge, for some you will need a subscription. If you're interested and want to support us, we would be very happy to have you there. We are currently in an open beta and all our premium features are available for free.